and welcome to this webinar on the outlook for markets through the rest of this year. The political world is obviously on tenterhooks at the moment, awaiting the outcome of a very close US election. But the financial world also seems oddly uncertain, and not just because of the politics. What's more, that uncertainty seems unevenly priced. So you've got rates vol really quite elevated, equity vol beginning to get there, and yet credit spreads and credit vol are really quite close to lows, and FX vol is fairly low as well. Similarly, half the investors I speak to and the articles I read seem to be worried about extended valuations, high government debt, risk of some form of meltdown, and yet the other half of the people you speak to are more worried about a melt up. And what I want to do today is to try to provide a sort of unifying framework for thinking about all of this. And to do so, I'm going to invoke the concept of the policy put. And in particular, not only the concept, but also the credibility of the policy put. Along the way, we're going to have to go through everything from the state of fundamentals in the US and Europe, through to the new stimulus in China, to why interest rate changes in this cycle had so little impact on the way up, and what that implies about their effectiveness on the way down. So with that, let's dive in. The central problem, as I see it, is one that investors have faced plenty of times previously in recent years, even over the last decade. And it's this combination of expensive asset valuations on the one hand, relative to policy seemingly designed almost expressly to extend those valuations further on the other. And there's lots of different ways you can try and demonstrate this, from the tightness of credit spreads through to high PE ratios, through to house price to income ratios, even just to simple things like I've done here, the divergence between economic indicators and like PMIs and market levels. But I think what I find most telling is almost the feel of it. It's when you speak to the bottom-up analysts, and especially in expensive sectors like tech or luxury goods. And they're usually quite open about the fact that they don't think their stocks or their credits are following earnings, except maybe when they get a really extreme announcement. Most of the time it's something else. Maybe it's price momentum, or maybe it's some macro factor, which instead seems to be dominant. And I'd even go so far as to say that almost all the investors I speak to are acutely aware of this dynamic, and about the only market participants who don't seem to be aware of it are the central banks. They're the ones who consistently downplay the importance of asset price inflation on the grounds that their primary mandate is for CPI. And unless there's some glaringly obvious risk to financial stability, then they're basically inclined to ignore it. And yet, a movie we've seen several times previously, at least in 2000 and in 2007, is one where that rate stimulus ends up not producing CPI inflation, but producing a bubble first and then a bust and subsequent recession in markets and the economy. And I think there is a risk that we get the same again. So for me, the three questions that we need to be answering here are, number one, to what extent is this dynamic relevant at the moment? Number two, if so, where are we in that process and how is it affected by rate cuts? And number three, how should investors position as a result? And that is more or less how I've divided up the presentation. So first we'll look at the extent of the market overvaluation relative to fundamentals and some of the similarities and differences between this cycle and previous cycles. Then we'll go on and we'll look at the nature of the policy put, and in particular, some of the interaction between interest rate easing on the one hand, and then on the other hand, fiscal stimulus, and then the central bank liquidity and the QT, which I'm going to demonstrate, at least until now, has been a bigger driver of market moves on the other. And then finally, we'll go on and we'll look at how investors are supposed to position as a result. I'm going to argue that the best trades are, as I see it, are really the ones that give you exposure to convexity or to tail risk. And we'll look at some specific examples across asset markets in both a positive and a negative direction, where I think that this is underpriced. But if there's one thing that I hope I can do in the next 30 minutes or so before we open up for questions, it's to convince you that the value of the put depends critically on the credibility of the agent that's providing it. And I think some of the odd behaviors that we're seeing across markets can be reconciled if you start to factor in that the credibility of that agent or those agents is becoming stretched. Now, I'm not in the camp that we're suddenly going to see the demise of the dollar or a complete loss of confidence in fiat currencies as such. But I do think that the system generally is much more stretched than is widely recognized. I think this is visible already in some of the dynamics playing out both in markets and in politics. And I think that some of the associated risks are worth positioning for already, even if it isn't actually your main forecast. So as usual, there's going to be lots of time for extra questions and more charts at the end. And you can either raise a virtual hand to ask them directly, or else you should be able to type them in to the Q&A box on Zoom, either as we're going along or at the end. To begin with, though, let's have a look at those overvalued markets. So the first thing I should say is that while I'm probably towards the more pessimistic end of the spectrum in terms of how much momentum I think there is behind the global economy, that's not where I think the problem lies. And I can't emphasize enough how different I think my approach is to the approach of most investors that I speak to. Most people start from an economic view, and then they try to trace through what that therefore implies that markets ought to be doing. But especially over the last year or two, and arguably over the last decade, that's been a disastrous strategy. I mean, even this year, just think about it, everyone was expecting recession at the beginning of the year, and then markets have done fantastically. Now, if you go back to our presentations from the beginning of the year, you'll see we were bullish on markets, not because we were more optimistic on the economy, but because we have a different view of what's been driving markets here. And I think you can take that further still and say a large part of why the economy has done so much better than everybody anticipated is because of the strength that we've had in markets. High asset valuations and high debt levels together contribute to this outsized importance that markets and maybe wealth effects take on. And even now, the biggest puzzle that the central banks are struggling with is why, despite the largest set of rate hikes that we've seen in decades, actually financial conditions have been easing rather than tightening. And I'm going to have much more to say about that later. But for now, I think the critical point is simply to say that whilst financial conditions are this easy, I can't see that much to worry about in terms of the economy. The last few recessions were all caused, with the partial exception of COVID, but by a big sell-off in asset prices. And so the fact that we've not had one is a significant positive for growth. It's just that I don't think feeling reasonably positive about the economy is a good reason to then be bullish on markets, especially when the valuations are so extended, or to be bearish for that matter on interest rates. We simply need to look at market dynamics and market valuations a little bit more directly. And of course, the moment that we look at those valuations, all sorts of warning bells start going off. It's worse in some places than others. And maybe one difference versus prior cycles is that there's no single place like subprime or like .com where you can say that clearly is the one place where there's a bubble. It's a bit more evenly spread. But nevertheless, generally speaking, equity valuations, especially in the US, especially in the tech sector, are really extended. And what's especially alarming is when you use, say, cyclically adjusted PEs or some longer term metric to factor in, hang on, we've got peak multiples on peak earnings. You need to be really quite bullish on NVIDIA and some of the other AI names to say, hang on, we're going to continue to grow at these rates when earnings and margins are already at cyclical peaks. And then likewise on credit, it's kind of difficult because credit spreads often spend quite a long time being relatively tight. And so timing shorting of it is difficult. But I think you can really clearly say versus history that the scope for further spread tightening is quite limited. And conversely, the risk reward in terms of spreads widening is starting to look relatively unfavorable. And even on the rate side, it's maybe a little bit better after the backup that we've had over the last couple of weeks. But nevertheless, there's been this sort of odd tendency for the market to want to price in more easing than the Fed themselves or the other central banks have actually been guiding us towards. It almost feels like whatever the market, the valuations have just been driven by default to expensive levels, except for odd occasions like 2022 or maybe like briefly summer this year, when the forces acting on them have become a bit more normal. And again, I'll have much more to say about that later on. So the snag is that even if the fundamentals are good, there are some signs that if we're going to allocate capital today, we might want to think twice about it given those valuations and given where consensus already is. And the place I'm probably most concerned about this at the moment is earnings. So I've seen commentators argue that actually the downgrades to consensus for Q3 mean there's a low bar and therefore the surprises can be positive and therefore you're supposed to be bullish. And I have to say that normally I view it the other way round. Actually, I find it quite hard to find a link between surprises on earnings day and market performance. And I get a much more consistent link over time with earnings revisions, with the changes to consensus and market performance, except when QE or something is interfering with the price action. And in this context, I'd say you have to actually be quite concerned that over the last 4 weeks, we've had downgrades to every single sector apart from financials, and we've had downgrades in every single region, including in the US. And in the US, what makes that all the more remarkable is that this has happened when we've had a little bit of weakness in the dollar. And usually one of the big factors that has an influence on earnings revisions is the currency weakness tends to feed into people being positive. So one way or another, again, you've got this elevated valuations and good fundamentals, but a sign that people are not getting any more positive on those fundamentals. Maybe a counter argument is to say that the level of earnings in itself remains really quite impressive, and on some of the blended metrics is still showing expected growth as we head into next year, especially in the US and expected, especially for tech. But even here, when you dig into the numbers, I read a piece about this back in February, I would feel much more encouraged if I saw the calendar estimates going up with the consensus getting more positive, and that's not what we've got. What we've got is this gradual drag higher as we get closer to next year, but it's not that analysts are actually getting any more positive on the numbers themselves, and outside of the US, they've often been getting more negative. Similarly, I would feel much more positive if I saw sales estimates rising, and instead all of the expectation is just for margins when margins are already at really elevated levels versus history. And so, yes, it's good, but it's stretched. And when we look at the margins, there is a positive picture, but it's a very US-centric positive picture. I don't normally like the bottom up, the equity measures of margins. They always tend to peak right at the top of the market. I tend to think a much better indicator or more forward-looking indicator is to look at the gap between output prices generally and then labor costs as most firms' most significant input. And when I do that, you see, and then you often get a lead indicator of where profits are going. You can see that US firms in particular have done a fantastic job, both on the way up and on the way down, of keeping their wage costs under control. Maybe immigration is one of the factors that's even been helping here. Whereas in Europe and elsewhere, you get a bit more evidence of those margins getting squeezed as labor costs have been a little bit sticky on the way back down again. But one way or another, I'm still looking at these numbers, and yes, they're reasonably encouraging, but it's all quite stretched. Now, what would normally happen, even if margins started to come under a bit of pressure, late cycle, is that you'd see companies leveraging up. They might no longer be able to improve earnings or EBITDA, but they can improve earnings per share by engaging in share buybacks, by engaging in M&A, by borrowing in order to do so. But this is another place where it's been a slightly odd cycle, at least so far. There's lots of scope for them to lever up. Indeed, on aggregate, leverage levels are really quite low at this point. Profits have been growing faster than debt. In terms of the leverage clock or the leverage cycle, you'd say, oh, it's 4 o'clock. And normally we would get more leveraging, and maybe there is still scope for that. But it feels to me as though something a little bit different is going on. When I look at what companies are doing with all of these profits, it's almost as though they think the party can't last. So one of the things that they would normally be doing when they've got lots and lots of profits is engaging in capex. And instead, actually, you see capex levels are really quite depressed. There are maybe pockets where there's capex, like AI, although ASML may make us wonder today. And similarly, there are lots of areas like the green transition where people say there ought to be lots of capex. There's a need for loads of investment. But when you actually look at what companies are doing, it's less enthusiastic than you'd think from the level of profits. And some of this in the US could be related to the election, but I think there's a longer term story here. Over the last couple of decades, in general, what we've seen is steadily less enthusiasm for investment, steadily more enthusiasm for returning capital to shareholders in the form of dividends or often share buybacks. And I think there's, and yet, even if I factor that in, that too, in a sense, has been less enthusiastic than you would have thought. Now, maybe it's just because rates have risen so much and there's going to be more borrowing and more payouts to shareholders, and you should be long equities versus credit as a result, and it becomes a much more normal cycle. But again, as I dig into the numbers, it feels to me as though something is holding this back. And my best theory as to what this is high valuations in themselves. I'm sort of suspicious that if we were going to get lots more M&A, which you would already have expected from the level of the equity market based on prior cycles, then we would have had it already. And the one place, rather amusingly, or maybe not, that we are seeing lots of M&A is from deals where private equity is a seller. It's as though the guys who are most price sensitive and acutely aware of long-term value are saying, I want to be a seller here, not a buyer. And maybe even this is one reason why returns for private equity have been coming down in recent years, because they've been forced to buy in recent deals at more elevated valuations. And that is a much bigger driver of their subsequent returns than, say, what's happening to interest rates. Maybe even you might say, why is it that the stock market is no longer rewarding US companies doing share buybacks in the same way as they would have done in the past? Could that too be a feeling on the part of investors, that more so in the US than in Europe, that when you're doing share buybacks, you're actually doing so at really quite elevated valuations? As I say, maybe that's too strong, but it still feels to me that even as the central banks are intent on making markets more expensive, somehow actually lots of investors and companies are almost pushing back. So to sum up this section on the economy, there's, in lots of respects, the level seems to be fine, but the derivatives are deteriorating. Growth is fine, earnings are good, unemployment is really low, margins are great. But in each case, the change is just beginning to disappoint a little, especially relative to those elevated consensus expectations. And one minor concern about this is, therefore, perhaps there isn't quite as much momentum behind that economic growth as is sometimes assumed. And on jobs in particular, I've seen a couple of nice articles this month. There was one by Claudia Zahn, there was another one by actually the City Economics team, arguing in both cases that payrolls were a bit misleading and you would do much better to look at job openings, which have been declining rather significantly. And likewise, you can maybe look at things that have been sometimes lead indicators like youth unemployment or like new entrants to the labour force, where again, the deterioration has been a little bit faster. But generally speaking, I'd say my major concern is not with the level of the economy or the state of the economy, so much as the state of markets. Markets are usually sensitive to these second derivatives. Usually when everything is good but not getting any better, well, that's when markets start wobbling. And it doesn't really feel yet, except occasionally in volatility in some places, as though they're doing so. So even though I sum up all of these fundamental indicators, even though they're there somewhere in my view, they're just not major drivers for me in the same way as they are for other people. Yes, I'm probably at the pessimistic end of the spectrum in terms of the economy on isolation and in terms of questions about future levels of neutral rates. And similarly, I think even when people correctly say, oh, don't worry too much about the manufacturing sector, that's much less significant than it was historically. Even when you look at the services sector, which globally is stronger, I don't think that by itself is enough to justify the extent of the strength that we have had in markets. And so ultimately what this means is the economy is a lagging indicator. Markets are the leading indicator, and it's not fundamentals which are driving them or even anticipation of fundamentals, it's something else. And that's the story that we've had for so long now, and where for me, it's about money flows and it's about central bank policy. So what we really need to do is to get our heads around that policy, understand how it's affecting markets, and only then, if we want, can we come back and think about the economy. So that's what I'm going to try and do now.